Last week on Friday, Nick, you wrote an article and did a video about Honeywell and talked about the conglomerate discount. Now, if you're wondering where you can catch that video, you can only catch it over on Semi Insider for now. You can get access to Semi Insider over at chipstockinvestor.com, where you receive all of our latest research first.
And all of the investment tools that we're building out that we use ourselves every day, make sure you check it out.
chipstockinvestor.com. Okay, so the conglomerate discount, we're going to be talking about that with Alphabet. And we know that a number of folks out there are calling Alphabet cheap right now. Let's dig into that a little bit deeper and talk about why it might not be exactly what it seems.
This has everything to do with the technical infrastructure and build out of those physical assets, data centers, power infrastructure, all the stuff that supports Google Cloud, as well as the Google advertising empire.
So there's a number of things that discount a stock when it's part of a conglomerate, meaning a huge business like Google that operates in many facets of the economy. And one of the key things that we can call out is lack of data transparency. You can see on the slide that we have a number of risks listed here, but the one that we want to pay really close attention to is data transparency, or lack thereof in this case, which is at the top of this list. We're going to flesh that out a little bit when looking at Google.
But let's not take too much away from the business. Let's just focus on that operating profit line there at the top of this chart. This is GAAP operating profit on a trailing 12-month basis, and Alphabet, driven by Google Search, as well as the ascendancy of Google Cloud, has been performing quite well. In fact, even through Q2 2026, operating profit has actually grown at a faster rate than revenue. That is about to change, though. And the big reason why, of course, is capital expenditures there in orange, which in Q2 sent free cash flow into negative territory, about negative $5 billion. On a trailing 12-month basis, Google still shelling out well over $50 billion in free cash flow. But as you by now know, the hyperscalers are going to be spending north of $800 billion in capital expenditures this year on data center servers and related infrastructure. And Google is making up about a quarter of that, now expected at about $200 billion in Capex for 2026. And they reiterated what they said before, their Capex will increase significantly into 2027. That is the primary data point that is driving the semiconductor boom. We'll be discussing more of those semiconductor companies as earnings season rolls on. So we think ultimately there's probably more upside to a lot of these hot semiconductor names that have recently sold off, including some of the memory companies, some of the optical companies. But Alphabet, yes, it's spending an unsustainable amount of money right now, but you can see why that is, especially in their Google Cloud segment. This was a really fantastic second quarter.
Yeah, you can see that in the Google Cloud revenue there at the end of this quarter in 2026, over $24 billion for the quarter, up from $13.6 billion this time last year, 80% increase. And then also in operating income, Google Cloud closer to $9 billion in operating income over this last quarter.
Yeah, if this pace continues, Google Cloud actually becomes Google's largest revenue and probably a ways off from the top operating income generator. Google Ads very much getting milked for everything they're worth. YouTube getting milked for everything it's worth. But pretty impressive there, Google Cloud, when you take into account the other bets losses and some other company-wide operating losses. Google Cloud now over 20% of the operating income overall. But Casey, we need to take a moment here and acknowledge, again, that conglomerate discount. Why exactly is Alphabet facing this conglomerate discount, specifically surrounding data transparency or lack of data transparency? You've probably heard this talked about now quite a bit, and I think the chorus of concerns are getting louder as time goes on. Let's talk about this.
We know there's a ton of text on this slide, so we're going to break down as simply as we can these VIEs, or variable interest entities. Those variable interest entities can be anything from data center leases, credit backstops, and power infrastructure. What's an illustration that would help us understand what a VIE is to Google?
So we briefly mentioned here recently this analogy that we've used about a business being a car. And you can think of revenue and the income statement as the engine, the balance sheet is the gas tank, and the cash flow statement, where you calculate things like free cash flow, is the vehicle's efficiency overall. You think about this business as a car, it's on a road trip headed towards a destination, and now you introduce these VIEs. And you can think of these as cars that are lined up behind your main company, your main car, that are caravanning with it. They're separate vehicles, technically speaking, but Google, in this case, still has an interest in them because your hope is you all get to the destination safely. So what happens if some of these subsidiary businesses that are off balance sheet because you have a minority interest in the subsidiary or the investment, what if one of them goes bad? The engine breaks down, the balance sheet runs out of gas, they go bankrupt. What happens if there's an accident and a pileup? Does Google just continue trucking ahead towards its final destination, or do they have to stop and deal with the aftermath of this?
It depends. Is it a family vacation or is this like with friends?
It does. It depends in real life as well. And this is where the lack of data transparency comes in. So let's break this down a little bit further. Here's the balance sheet, the normal, easy, high-level balance sheet that we like to look at. Nice and clean. We have total cash and equivalents, non-marketable securities, which include equity investments in companies like Anthropic. And then you have your long-term debt in orange, and then preferred stock. That would be one of the investments that Berkshire Hathaway announced a few months ago. So nice and clean here. Over $240 billion in total cash and equivalents. Non-marketable securities over $130 billion. And then debt looks like a very manageable $98 billion. It would appear Alphabet has all the liquidity it needs. It's got a full tank of gas and most definitely a destination. Destination supplying AI infrastructure to everybody that needs it and wants it.
But this is where more of the lack of data transparency comes in, more of the opaqueness of the balance sheet. We're pointing out a couple of items here: equity derivatives and credit derivatives. You can see from last year, as far as the equity derivatives go, it went from 0 to 20 billion. And then on the credit derivatives, jumped from 17 billion to close to 44 billion. Now, where is all that coming from? And what are these?
Nobody knows. Alphabet knows. Its accountants know. But we're left doing the guesswork. The equity derivatives going from 0 to 20 billion, that could involve the deal with Berkshire Hathaway, supplying some funding for Alphabet to build out AI infrastructure. It could be part of the deal with Anthropic, supplying it. The credit derivatives, credit backstops, that's probably more like Alphabet funding its data centers and power infrastructure, renewable power entities, companies that are tasked with, let's say, acquiring everything from solar panels to gas turbines. Google doesn't want to deal with that directly, but they'll most certainly use it once it's acquired and installed. So that's probably a little bit more straightforward, but ultimately we don't know what those are. And that's why we have continued to call out when in the future there's an issue in the economy, especially this new AI-driven economy, it's probably going to come from private markets, private credit and private equity markets, because all of this stuff, these VIEs, would fall into that basket. There's a lack of transparency, the lack of data on what's actually going on. Of course, that creates risk that we don't know about as investors, and therefore it needs to be discounted in the stock price.
And if you have more interest in reading about commitments and contingencies and all of the other things that Google lists in its latest 10Q, we've got that right there on screen. We'll link it in the description below for light reading.
And honestly, even beyond just some of these VIEs, I think for a long time now, one of the largest risks is Note 10, which we have listed here. You can find starting on page 30 through 33. Long laundry list of companies ranging from regulators in the US, regulators in Europe, other companies suing Google. There's also disclosure in there. They sold off G Fiber, but retained a minority 49.99% interest. They're getting sued by Klarna. They lost that case, but appealed. I mean, it's a laundry list.
I feel like you don't actually want to read this.
We wrote about this, though, all the way back in 2019 when it was becoming more apparent that big tech was falling into this big conglomerate definition, though, that at some point in the future, it's going to be in shareholders' best interests to see conglomerates like Google broken up into smaller pieces so that there is more transparency on what's actually happening under the hood. Not saying that needs to happen right now, but that's why companies like Google at this point probably deserve the discounted valuation that you're looking at.
So let's take a look at this through the lens of our investment thesis checklist, which you can find over at chipstockinvestor.com. Qualitative metrics all look really good for Google. They're part of a secular growth trend. They have a relatively long sales cycle. And I think we could definitely say they have a large breadth about them, right? It's a huge company, as we said at the outset. But when we look at the quantitative metrics, that's a little bit different story.
Yeah, revenue obviously still growing at a nice pace, especially Google Cloud. That's fantastic. As that becomes a larger percentage of sales, that will probably help offset some of the slowing growth in search revenue and ad revenue. But more recently, we now have to call into question the GAAP operating margin because of the higher depreciation expense from all of the purchases of capital equipment, free cash flow going negative, and it may stay depressed all through 2027 based on early comments from management. That means per share profit gets called into question. And you can see that in the valuation on a trailing basis. Google trades for something like 16x price to earnings. On a forward expected basis, something like 24, 25x though, because the market is now expecting during this period of massive infrastructure build out, their growth in operating profit is going to start to decline. All that Capex is going to finally start to catch up. Also, the balance sheet is a big question mark. It's opaque, not entirely sure what's going on. So how do we feel about Google? One of our top positions. We thought it was definitely pretty cheap all the way through last year before it went on its run after one of the big antitrust cases got wrapped up in mostly Google's favor. Now, I don't know. It may appear to be cheap on the surface, but I'm not buying it. I'm not buying that this is a cheap, underappreciated asset. Still happy to hold it, but
yeah, you can see that we added a little note on our investment thesis for Google. That increasingly opaque balance sheet that you just mentioned means there is that conglomerate discount.
Past statements also still apply, though. If Alphabet and the hyperscalers all start to pull back on that capital spending, that's probably not so great for the semiconductors, but we could see a resurgence, a very large run back up in operating profit and free cash flow once they do that. So I think this is probably still, at least in our opinion, part of a well-balanced portfolio and a soft hedge of sorts against the semiconductors.
We'll, of course, keep you updated and get all of our latest research, as we said at the beginning, at chipstockinvestor.com. Make sure you hit the subscribe button, and we will see you soon. Take care.